Welcome aboard here, guys. It's Walter here, full-time trader. Wrote the book Naked Forex, and today we're going to talk about Naked Forex. I'm a little bit sick here. Just came back from holidays today, and sore throat from chasing around the kitties, I guess. I don't know. Playing with the kitties and going to crocodile swamps and stuff, trying to keep them safe. Maybe that's what it was. Anyway, we're going to talk about our pullbacks. Now, I am happy to look at any of the charts that you would like to see. I apologize if I am very efficient with my words tonight, although that's pretty much a good thing to be, I think. So I'm going to try and be as efficient as possible when I talk tonight and speak, because I don't want to lose my voice any further. What I want to do, though, is I want to talk about pullbacks. Now, when we're talking about pullbacks, there's a couple of different ways to see them. One could be as a pullback to a support and resistance level that the market hasn't been to for a while. So it's kind of like a revisit of a zone, so to speak. And another, like for example, on the yen right here. So you can see I'm pulling up the yen. This is the yen daily chart. So if I get rid of this grid, we'll do that. So one way to look at a pullback would be like, okay, it looks like, for example, we had all this support on the yen right here. 5 days in a row, it kind of bounced off this level, and then it broke through, and now it's coming back to that level, or potentially coming back to that level. So that's one way to look at a pullback. It's a revisiting a level. But another way to look at a pullback, of course, is to look at a chart and say, well, the market's pulling back after it made a strong move down. So you have this strong move down here on the yen, and then you have this pullback. So that's where a lot of like retracement traders, the fib guys, will kind of play in this world. When I say the fib guys, I mean the guys that are looking at the high to low move, and then they say, hey, this was a 50% pullback, so I'm going to get in at the 50% pullback. There are all those guys that trade the fancy patterns like the bat and the frog and the whatever, the Tinkerbell and the whack-a-mole, or whatever those geometric patterns are. And they're looking for the same thing. They're looking for specific pullbacks to fit into a pattern, and then they trade it if that happens. Well, what we're going to talk about two different types of pullbacks. We're going to talk about a pullback to a support resistance level. Like I talk about in the Naked Forex book, a lot of what I like to do is trade, although not exclusively, I do like to trade support and resistance. I think it makes a lot of sense from a number of areas. But what we want to do today is look at two different types of pullbacks. One is a pullback during a trending market, and another is just a revisit or a pullback to a level that was important before and potentially could become very critical again. So let's get rolling. If there's any questions, or if you guys want to look at any of these live markets right now from a naked point of view, I'm more than happy to do that. So here we are. Number one pullback scenario I want to talk about is the pinch. Now, what is a pinch? A pinch is when the market let's look at this one, because this is interesting. Well, I don't want to start off with a loser. I want to make sure that you guys see a really good example first, then we can look at the losers. All right, so here is a imprinting is important. So here is and this is a, if you're familiar with the last kiss method, I wrote about this in Naked Forex, and it's actually all over YouTube. I didn't even know this a couple of years, I think last year it was, or maybe the year before. I was on YouTube and I saw these people talking about last kiss. I'm like, oh wow, that's funny. I didn't realize it was that popular of a thing, but you can find it all over YouTube. I've got plenty of videos on it too. So what it is it's a special type of breakout from a box. So you got this big consolidation box here. Not sure exactly why I started it here. I could have easily started it here, but whatever. Got this big box here, and I've got a floor and a ceiling on the box. And when the market breaks out of the box, it comes back up and it confirms the breakout with a touch. And so this is the signal candle on the last kiss. Well, it turns out not only is this a last kiss, but it's also what we would call a pinch trade. Now, pinch is not my invention or term or whatever. It's my friend and great fellow naked trader, Denis, in I think he's still in France. He kind of brought this to my attention, and it's awesome. It's a great way to trade. All you're really doing is waiting for the market to break out and touch again after it's been trading in a trend. So you kind of like here would be, this potentially could be one right here as well. Let me have a look. This would be another potential one. Let's just have a quick look here. Yeah. Well, yeah, it might have gone a little bit too far there. That one might have not been ideal. But you can get them bullish as well. So here's another one. Let's say that we have, we have a very well established level here with this touch here and then this touch here. The market breaks out, comes back down, and boing, bounces right off of it. So that's your pinch right there. That's a bullish pinch. So the signal candle is here. And once you get that signal candle, you put your buy stop above that signal candle or your sell stop above that signal candle. Now, you can put your stop below, whoops, a swing low like here, or you could put it below the signal candle right here. Either one, really. It doesn't really matter. Could be there, could be there. Now, it makes a lot of sense to use the signal candle, but sometimes if you're worried about a double bottom, you might move it a little bit further out. And that's because double bottoms are very, very common. There probably was a double bottom here, even though it didn't show up on this is a 6-hour chart. There certainly would have been one most likely on the 1 hour or 2 hour chart or something like that. Okay, so here's a pinch right here. You can see the market's broken out of the box. It comes back up. There's your bearish candle. It trades lower. Now you can have your stop loss, like I said. You have your stop loss right here above this swing high, or you might have your stop loss above the candle itself. If you have it above this swing high, you survive because it does in fact double top. However, if you have it over the signal candle or the highest candle in that immediate vicinity, you're probably going to get stopped out on that wick right there. Okay? So that is an example of a pinch. Now, a couple of important things to keep in mind with the pinch is they happen almost immediately. So it's really only after a few candles beyond support and resistance. You see here where we're 1, 2, 3, 4, 5, 6, 7, 8. 8 candles after the breakout, and we're already back up there. So that's the defining feature of the pinch, and then you'll see why I'm emphasizing this in a minute, because we have other systems that are similar but not the same as the pinch, and for obvious reasons. And one of the obvious reasons is what I just said. That a pinch is really just that. It's the breakout confirmation that happens right after. Number two is that your pinch has a clear signal candle. It must be in the direction of the trend of the move, and in this case that would be down. You'll also see, as we talk about in other pullback strategies here, naked Forex strategies, we will talk about how with some of these you actually don't have a clear signal candle. You're actually trading blind, and you don't really have a very good reason to take a trade other than it fits the pattern. So you're not getting candle confirmation. Another way of saying that is that the pinch has very, very clear candle confirmation. And while that's why all the systems in naked Forex have candle confirmation, if I were to write another book, I would write about other strategies where you get really high reward risk ratio. You have lower win rates, but you get really high reward risk ratios because you don't wait for the confirmation. You're always going to get a better payoff in the markets if you take a trade without that confirmation. That's just the way it works. So fortune favors the brave, or whatever you want to call it. Okay. And you really don't want to see the pinch go on the other side. So it must respect the zone. It really must respect the zone. And I know some people let it get a little bit sloppy and the markets aren't perfect and all that. But for me, for my money, if I'm going to risk capital on a pinch trade, the pinch must respect the zone. If it doesn't do that, it's just not a pinch in my book. So there you have it. And again, like I said, I give full credit to Denis in France. He's the one that brought this to my attention, or gave it the name or whatever. And it's a great strategy. So there you have it. All right. Any questions about the pinch? Pinch making sense? Everyone cool with that? If you cool with that, we're going to move on to the next one. So remember, the pinch doesn't necessarily have to be in a trend. It just has to really be it's nice if it's in a trend. I prefer to trade it in a trend and have a really clear direction. But, it can just be the fact that the market, and some people would say that this was not a trending market, given the fact that it was sideways from May until June, from May 10th until June 10th when it broke out, or June 9th when it broke out. So I could see where people would say that for sure. Cool. All righty. No questions? We going on then. That's it. We going on then. All right. So number 2 strategy I want to talk about is a great one that I just had the other day. And if you follow my trades in the forum, you know about this one. But this one here. Okay. So this was a trade on the pound Swissie. Oh, and by the way, I should mention that I am a big fan of the open position ratios. So I'll show you how this works. If you've seen any of my videos on YouTube or whatever, Facebook, whatever, you probably know about this. But what I've done, my programmer has created this fancy schmancy page for me that updates the open position ratios at IG Markets. Now, the only reason I like IG Markets, they have a lot of traders under there, that have open accounts with them, and they have a lot of pairs that they offer this data for. Now, that's not always the case, like Saxo Bank and Awanda and the other ones that offer these data. They don't actually have all of the pairs that I can get from IG. So my awesome programmer created this page where it updates all these numbers. And so, for example, I know right now that the way to read this is that 87% of the market is buying pound Swiss. So I'll tell you which group I'm going to be in. Every single day of the week, I'm going to be in this group right here. And I just blurted it out, blocked it out. I'm going to always be in the 13%, the minority here. What we know from watching retail traders, these are retail traders, these are not the pros. What we know from watching retail traders trade is that they look for trends and they try and find the absolute turning point of the trend. They go against the trend. And if you think back to when you first started trading, I certainly did the same thing. When I first started trading, I did the same thing. I saw the euro break $1, for example. That was a big deal back in 2003, I think it was. 2000, can't remember if it was 2003 or 2002. I think it was 2003. Might have been 2002, and end of 2002 maybe. And I was trying to sell the euro against US. Oh, I can't believe it broke $1. They're gonna send that right back down. Well, they still haven't yet. Here we are, 17 years later. It still hasn't gone back down below $1, has it? The euro. So there you have it. So yeah. So I really like using this as a trend indicator. So for example, I'm short pound Swiss now. I'm short the pound. I'm long the euro pound. So I'm in the 19% of traders who are long the euro pound because 81% of them are selling. And don't have any on here. I got a whole slew of trades too on the Aussie Swiss, Aussie dollar, which is interesting that that's fallen out, and the Aussie Swiss, Aussie yen. Got one here. on the dollar, yen, and so forth. So really, the key here is that you can use these open position ratios as I do, which is as a trend sort of indicator. How strong is the trend? Now, let's talk about pound Swiss. With the pound Swiss, we had this. It was a beautiful downtrend. The market's been going down, down, down. And then, that's not a trend line. I'm just drawing a down thing. Kind of looks like one. Then what happens is the market finds a floor here and starts boxing up, makes a box. And it printed this lovely looking candle right here. Now, this is not, I repeat, it is not a kangaroo tail, because it doesn't fit the rules in the Naked Forex book. So mostly it's because the close here is not inside the previous candle's range. It's what we would call a pseudo kangaroo tail. Typically that happens when the previous candle is so small, it's hard to get the open and the close inside the previous candle's range. I wouldn't really call this one a pseudo. I would just call it a bend trade or whatever. Again, I'm just trading the edge of the box here. I'm trading support and resistance. I see this candle. I think, okay, I'm going to sell at 26.09, which is just a few pips below this low here. Oh, much lower, isn't it? Hang on here. 26.09. It must have. Oh, I think it was this candle actually. This candle had a low at 26.28, and this candle fell down a little bit, and I just, to 15 or 16 or something, and then I decided I would put my sell order down here. That's right. That's what happened. So it was below this candle instead of this one because I didn't see this candle print, and I did see this one, and I said, okay, I'll sell if it makes a new low, and it did. Came back down here, bounced up, and I knew it was a pretty good chance it would come back to down at the bottom of the box and come back up. It didn't really. It came down, broke out, came back up, never gave you the last kiss opportunity here. It hopped right back up, and then finally fell and finally hit the 3R target. So the risk to reward ratio on here was 3R. It was, what is that? 68 pips of risk to make 300 pips of reward, or whatever that is. Is that right? I don't know, something like that. 210, I don't know, 210 pips of reward, something like that. Anyway, the point is that this is a great way to trade a pullback. If you have a clear bias, like I did on this one, and you know where you want to go. I wanted to sell only on the pound Swiss. Still do. Then guess what? If the market's in a consolidation box, you can play the edge of the box. There's no rules telling you that you got to wait for the trend to kick back in again to do this. So that's why I really like it. What's nice about this style of trading is it gives you a head start, because you're kind of getting in with, and you've already got this much movement that's really, really likely to go in your favor. It's really, it doesn't have to. Of course, you can get stopped out, and the biggest, easiest way to get stopped out is to have a stop loss that's too tight. I like to put mine well beyond the signal candle. But if I were to take this trade, I already know that we're in a box here and we're bouncing off the floor and the ceiling. Well, if the numbers are where they're at, I know there's a pretty good shot that it's going to fall. The market's going to go down to the edge of the box, and I'm probably going to get at least that. And there's a whole bunch of traders that will just trade that. They'll trade from here to here. They're trading the 15-minute or the 1-hour charts or whatever it is, and they're just trading these levels. They're selling up here and buying down here and whatever. And that's cool. I get it. Makes sense, But what I like about this is by not waiting for the traditional last kiss, I've already got this much movement likely to go for me. Now, who knows if it's going to go beyond that, but that gives me 90 pips right there. Oh, no, not quite, because the sell was right here at 09. Not 90 pips. It gives me 56 pips or something like that. 56 pips when I had, 67 or 68, so it gives me almost 1R right off the bat. And then if I'm right on the trend and it breaks down lower, then it becomes easier to hit my target, which was 23.99 in this case, which is actually up. I think it was hit on this candle. I think it missed on this candle and then hit on this candle. But anyway, it doesn't matter. The point is that this is a very great way. It's an awesome way for you to trade if you have clear direction. You wait for the consolidation and you just trade the edge of the box. Yeah, you might get stopped out because it could come up here and spike even further on the edge of the box before it finally goes. But the good news is once you have a direction and you know which way you want to go, it makes it really easy to make a decision on, where you can go, because I can go at any resistance level I want to when I think that the market's really likely to go lower, like the pound Swiss. So this is a great way to trade pullbacks as well. And you're trading the pullback within the box. Again, it really, excuse me, it really is a trend continuation trade, but you're trading the pullback within the box. Okay. Any questions about the old boxed kangaroo tail? That's what that is. I know it's not that wasn't exactly a boxed kangaroo tail, but because it wasn't a true kangaroo tail, but it's really kind of a boxed trendy kangaroo tail is what would we call that. Let's move on to numero 13. All right. And now this one, I think we got an interesting one brewing right now on no, not this one, not the Aussie Swiss. I'm sorry. We already went over that one. It's the Aussie Yen. Okay. This, my friends, is awesome. Now, I will point out that there is a problem with this chart. There's one thing wrong with this chart. There's a thing that I don't like about this chart. There's something that's really bad. Okay. It's definitely not the best example of this sort of trade. Okay, it's not the kind of thing that I would say, is ideal. But I will say that I love these. I really do. They're so cool. And here's what they look like. You get an Aussie yen. You get a support resistance level. So you have support here back in May, support here, support there, support there. The market falls off, okay, gets well beyond support, and then comes back up after a long time and touches that level once again. It just happened in the last hour and a half. Actually, really within the last half hour. This just happened. 45 minutes. So what's great about this is you can actually take a first touch without any real signal. So you don't have to wait for candle confirmation. You can just go in. And I will say that there is an issue with this one. That it's not perfect because of this. This is super messy on this one. You don't really want to trade these unless you have this is a very well-defined support resistance level here at 75, 0.35 on the Aussie yen. It is. It's great. The issue I have is that we had this false breakout here. And that's not ideal. I would rather not see that on these. I would rather that it just held, and then finally broke. Okay? But the fact that it broke here, then came back up and then held, and then finally broke again. Again, you would have seen on the lower time frames a pinch right here. So if I zoom in here, I know this is a 6-hour chart. So you have your breakout, your retouch, and then your fall. Somewhere in here, you had like a 2-hour chart or a 1-hour chart, or somewhere in here, 15-minute, 30-minute chart. That would have given you a nice pinch right there. I can guarantee it. So that's very different to what we're talking about here, because the first touch is not the breakout and retouch, but the first touch is the first time the market gets there after it's been below a level or above a level for a long time. So it's come all the way down here. And then it finally makes its way all the way up here like it did just now today. In like literally minutes ago, less than an hour ago, it made this touch. So how do you trade these? How do you trade these pullbacks? Well, number one is you want to make sure that it's not a pinch. So it usually is at least 10 or 20 candles before it comes back. And often it's many more than that. Let's see what we have here. Is that right? 40. Is that right? 40 candles? Yep, 40 candles. So that's about right. I mean, that's really kind of in the sweet spot here when you're talking, 20 to 50, 60 candles like that. That's really where you want to see it. It can happen after 200 candles, but that's not ideal. You really kind of want to see it like this. So a lot of the lower time frame traders, they've forgotten about this level here because it's off their charts. They're only looking at these candles here on their 15-minute charts. They may not be looking all the way back here. So they've forgotten about this. And the daily traders, the guys waiting for confirmation, they're not going to see, if this ends up being like a daily kangaroo tail or whatever, they're not going to see this for hours and hours and hours from now. So here's the payoff. The payoff is, so the way that this works is you wait for a really well-established zone where you have many touches, as in more than 2 or 3, right? Which is exactly what we have here. I mean, I don't know how you would count this, but 1, 2, 3, 4, 5, something like that. 5 touches. And then the market comes back up and touches it, and you just sell right on the level. So this might not even have triggered it, and you might have to wait for another candle to push into this, or maybe later we have 270 minutes still left in the 6-hour candle. Maybe the 6-hour candle will push higher and get in there. But what I like to do with these is I actually like to put my order a little bit above the level. So I know it says 75.36. I might put it at 75.45. So I wouldn't have been triggered yet on this one. But I think you still have a chance for that to happen. You're only 25, 26, 30 pips away from that right now. And who knows what's going to happen to this candle and the next one and so forth. But what you'd love to see here when this happens is a wiki candle. You'd love to see a wiki candle kind of push into here and then it falls away. And sometimes it'll, more often than not, it'll make a half-hearted attempt to double top here and then it'll fall away. And what you get on these is a really tight stop. Like you could, like on this one, on this pair, you could probably get away with like a 40 pip stop, maybe even a 50 pip stop. Because if I have a sell right here at 45, 80 puts me up here, 85. So I have a 45 pip stop. I target down here, 40 pip stop, 130, 140 pip target, where the floor is down here. That's how you trade a first touch trade. Very different to the pinch. Very different. Pinch is happening like now. First touch is long ago. So pinch happens within 5 to 10 candles typically, and then the first touch is usually like 20 plus candles before it comes back, and often more, like we have here, like 40. So that's how that works. Any questions about the old first touch? Again, you don't have to wait for this to turn to kangaroo tail or a big shadow or any of that business. All you're really doing is as soon as you see the market, like you could literally put your order in as soon as you see the market down here. You see the market down in this area, you go, okay, it's already made the pinch, and you see it down here, especially I get really excited knowing that it's probably going to come up. And what's even better about this particular one is if I scroll down to my Aussie pairs, what's going on with the Aussie yen? 85% of our traders are what? 85% of our traders are going long Aussie yen, which means I definitely want to be in the 15% of the traders who are selling. So this is most likely simply just a pullback. Okay? All righty. Any questions about this bad boy? I'm happy to keep going. Actually, we have more than just today's. Just 3. Like I have a lot more than just 3 here, so I don't want to like totally. There are many different ways to do this, obviously, and using the ones I've showed you, these are some of my favorites, but there are others. So, for example, if you were a more conservative trader, you might use what's called the drop trade. So, drop trade is a pullback during a trend. So, this is a downward move here, downward trend. Now, this is a pretty significant retracement here, but you just wait for the market to fall away beyond this trend line. So if let's say that the Aussie yen comes down next week, it hits here, finally breaks through. There's 2 places I can get in on the drop. It can be after the big bearish candle here, or It can be when the market comes back up and hits it right here, and then gives me a bearish candle off the bottom of the trend line right there. Obviously, you can flip these and you can have a reverse drop trade, but the signal would be right there, or it would be a little sell order below the bearish candle. I'll show you one that may happen. It doesn't look like it's going to happen now, but you can put a sell order below the candle low right here as well. You don't have to wait for the pullback, because of course it's not guaranteed you'll get one. But pound yen is showing one of these, or was showing one of these right now. So here is your first of all, again, we have a direction. We want to be short pound yen. Why do we want to be short pound yen? Because everyone's buying. Oh, hang on. Well, the numbers were they were short. They actually did right before the webinar. I pulled them up again. I'm pretty sure they're still bearish, but just before the webinar, I pulled that up, and it didn't pull the numbers through that to my page, but I can double check that. Anyway, the point is, if this ends up being a touch here on the bottom of the trend line, and then either this candle gets wicky or the next candle gets really bearish off this. Again, we have 265 minutes before this 6-hour candle closes. Then that would be a signal on the pound yen. Otherwise, I can wait for the next one or whatever. If it's not going to respect this trend line here, then it's obviously not a drop trade. I wouldn't do that. I would probably, if this doesn't work, if this touch here, if this isn't a true touch, then what I would probably do is I would look at this from a box point of view, and I'd say, you know what? I think we're in a box, and just trade last kiss. Here's the bottom of the box here, and here's the top of the box up here. Do something like that. That would be the other way to do it. So drop trades are another way to trade. They're really, really great during down or up trends. Let's see if we can find an example of one, maybe on the old, thinking on the old euro pound here. Yeah, not so much. Just seeing if there's one here on the CAD earlier. Not really. EuroCAD maybe? No. I think we had some on the Euro Aussie and Euro Kiwi earlier this year, actually. Let's have a look. Let's have a look. These two were both trending upwards earlier in the year. Yeah, so here's one right here. I mean, this one's tough because that's pretty steep. I'd probably trade it more like this one. And this is such a massive candle, you almost have to trade the pullback. But the end of the trend was here. I got caught here too. It didn't really work out. Let's see if we can find another one here. These are more boxes than pullbacks. Here's one. This is a great one here. So here's a bullish example of that. Assuming that you're long here, I don't know, it hasn't taken out this high here. You might not be ready to go long, but let's say the numbers are really good. You can use this pullback. Boom. There's your breakout. Put your buy stop above there. It did pull back. Didn't get all the way to the trend line, but it did pull back here to the support and resistance level. You put your buy stop there, stop loss down here, and you're off to the races. So that's an example of a bullish one. I will, yeah, that's drop trades. You probably know about flags. That's another one to trade. So typically what happens with these flags is you will see, like maybe you're seeing one right now on oil, I'm not sure. Typically you get these really strong markets, and then the market goes slightly against the trend. So it's more like a drop trade, but you've got a very defined other side of the. So whereas the drop trade just has a trend line down on a bullish trend and a trend line up on a bearish trend, to hold in that move against the trend, with a flag, you have two sides of it that contain that. And again, all you're waiting for is you have two options on these basically. You wait for the confirmation, it breaks out of the channel of the flag. Put your buy stop above that breakout candle, or you can play the bottom of the channel, hoping that that's the last touch. You get more of a head start, obviously, if you get in down there, because it's quite likely it's going to at least double top up here, but probably go beyond if you've picked your trends wisely. But there's also a chance it can stop you out because it could go lower and keep falling down. It may not be ready. So that's why I like to wait for, if I'm going to trade the flag, I will wait for a kangaroo tail or something like we had on the Euro Pound, actually. I'll show you. On the Euro Pound had one. It was right here. So I traded this kangaroo tail. So this was a bull. I'm still actually in this trade. Sorry, it wasn't that one. It was this one back here. This one was a little bit tricky because the candle actually went beyond. Normally, these candles don't get so bullish that they go beyond the trend line here. So this was a reverse drop trade here. Here was your pullback right here. So it did give you the pullback. So here's the signal candle. Here's the pullback right here. And it hasn't gone as high as the target. The target's up there at 90.10. So I'm still kind of waiting on the 3-hour target on that one. But that's an example of a bullish, both a bullish flag and a bullish reverse drop trade. You can also trade trendy kangaroo tails, which are kind of fun, or trendy big shadows. So if you've read Naked Forex, you know about big shadows, or you've seen them. I think they're like last kisses. I think everyone's, I've got videos on them on the internet. Other people do too. They've kind of picked up this idea, but basically a trendy kangaroo tail fits all the criteria of a normal kangaroo tail, except for the fact that it doesn't necessarily, like here, this time frame here on the this is exactly where you look for them. So this is the first of all, it's a bullish. This is the S&P 500, so this is a CFD chart, and the S&P 500 is in a bullish trend right now. So what you wait for is kind of like that drop trade setup, right, that we had, but then it's punctuated by some sort of kangaroo tail here. Now, the difference between a trendy kangaroo tail and a normal reversal kangaroo tail is a normal reversal kangaroo tail like this one right here. This is going to have all kinds of space because there are no candles here that are printed in so long. Look at that. Like, there's nothing here. Right? There's nothing to the left of this candle. This much of this kangaroo tail is printed in a unique space, a unique area in the chart. It didn't go far down before it would have been stopped out on this candle. But the trendy kangaroo tail is different because it's only going to have as much space as the pullback has allowed. Because it's a pullback, it's there's not, like, I know this is not a long-tailed kangaroo tail, but let's just say it was this really long kangaroo. Then you would have this much space all the way back to basically here, and that's it. So you wouldn't have a lot of space. You're never going to have a lot of space in a bullish or bearish trendy kangaroo tail. Now, it doesn't have to be a kangaroo tail. It could also be a big shadow. So you can see these same setups where the market's retracing the major trend, whether it's a downtrend or uptrend, and then boom, the end of that retracement is punctuated by either a kangaroo tail, like in the case of a trendy kangaroo tail, or you can get a big shadow, and that big shadow will punctuate your move. Basically it's a clue. The move is over. It's not going to do this anymore. Let's re-engage. So you might look for some of these on gold right now, possibly silver. I know silver looks a little bit more bearish to me than gold, but whatever. And who knows about Bitcoin? Here's what we would call on the Aussie Singapore kind of like a first touch trade. I don't know if I would probably draw my zone like this. So candle number one, remember I was talking about on the Aussie yen chart how sorry, I'm losing my voice here, guys. On the Aussie yen chart, I said even if you didn't get in on that first candle, there might be another one that will go a little bit further, and that's the case. I know this has fallen quite a far ways from the high here on this current candle at 33. It's all the way down to 14 right now. But there's no guarantees this is it. I mean, it's likely that another candle or even a later double top or attempt at a double top will come and click you in. So it's easy to get nervous on these if you don't get clicked in when it first hits it. But see here, it hit it. And then now we've got this candle right now. So maybe, just maybe, this is another first touch on the Aussie Singapore. Again, what do we know about the Aussie? Well, we know that a lot of traders are buying Aussie pairs right now. A lot of retail traders are buying. So we definitely want to be in this small group. In this case, it's 4%. Look at that. I love it when it's like that. Well, part of that is because not a lot of traders trade the Aussie Singapore. So it's easy to get overweighted like that. But, I mean, that it just screams downtrend when I see that. I know that this is in a very, very lovely downtrend. It doesn't mean that the Aussie Singapore is necessarily stronger than, say, the Aussie Kiwi or the Aussie Swiss or whatever, because it's such, it really is, I think it's more of a reflection of the fact that not a lot of traders trade the Aussie Singapore. I think that's part of the deal. All right. So what I'll do now is I'll talk about the pairs that I really like. So this is another potential first touch trade. Here's your pinch. So here's your support level. Now I'm pretty sure you've got some more. Hopefully this has been well established. You got another touch or something way back here. Yeah, it looks like it was the end of December close right here, but whatever. The point is that, I mean, this would be better, obviously, if it was this level. This is a much better level because of all these touches here. And we've got a nice one here. We've got a nice pinch here. So here's the breakthrough. Here's the retouch right there. Happens almost immediately. That's the pinch. And then now this is the first touch. So this is the really... So in something like this, if I had sold, right, let's just say right on the line at 55, and I used 40 pips of risk, so 95 would be my... It's all the way up here. That's probably this is not a very volatile pair. Could use probably 30 pips or 35, but let's just say I use 40, and then I could go for 90 pips down here, something like that. Or use a trailing stop or nice round number down here at 93 even or whatever. So that's another example of a pullback trade. So there you have it. Now, what I want, and these don't necessarily have to have a high win rate because you can get them really tight. The thing is, I don't know what the top of the candle is going to be because I'm getting in just sight unseen as soon as the market hits my sell order. It's a sell limit, and it's just going to trigger. And who knows where the stop's going to be? So I kind of have to decide. Obviously, I have to decide that before I see these candles here. So that's the downfall there, that you don't get a chance to really check out what's going on. All right, so for me right now, pairs that I'll be selling soon will be the pound yen, most likely, and the pound CAD when it breaks out of this box. It's kind of in a big old ugly box right here, the pound CAD. There are also potential sell trades on the Aussie Swiss. Pullback here. Maybe it's going to come up into this level right here. See, you got support here, support there, and you got this candles bumped into that. Numbers are very bearish on the Aussie Swiss. Definitely the Aussie yen. We talked about that. And then also, we have the Aussie CAD is a great one too. What if the Aussie CAD comes up here and bounces off 92.15? That would be a great spot for a sell. And Euro pound, I'll probably leave that one. Pound Singapore is another one. Where's my pound Singapore? There it is. Pound Singapore is in this big ugly box, and it needs to break out. Give me a bounce off the bottom of the box down here. If it does that, that would be a lovely retracement move. I don't know when that's going to happen, if it's going to happen soon, but if it does, I'll be here waiting for this move to happen where it comes back up, hits it pinch style, just like the last kiss rules dictate, and then falls away like that. So that's another one right there. And again, if you look at the numbers, I don't know if I put pounds. Did I put pound Singapore on here? Yeah. Yeah. 88% of traders are long, so I want to be in the 12% here who are short. So that's that. Okay. Hey, folks, I really appreciate you spending time here today. I wish you very happy trading. We'll see you in the next Naked Trading Nick and Forex webinar. And I wish you happy trading. Have a wonderful day, a great week, and I hope you hoover up a lot of pips. Have a great one. Thank you very much. Take care. Bye.